There are some things I'll take a chance on, but life is already enough of a gamble for me to put my whole nest egg in the share market. So I take a calmer path. By investing in private credit, I know my money could be growing, not yo-yoing.
From Barangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Hi there, welcome to the COB on this Friday afternoon. It's always a pleasure to be here with you, whether you're watching live, on demand, or if you're listening to podcast form. If you are listening while you walk the dog, as I'm told many of you do, I'm sure you already know that it has been a stellar session for the S&P ASX 200 today and the CBO Australia Index, which you see on your screen, going from strength to strength, 8,935.6, just past 4 here in Sydney. So we'll continue to keep our eye trained on this market. I'll run you through the sectors in just a moment, but I think it's safe to say that the financials, the materials, the energy names have all lifted, and that has just done wonderful things. 8 out of the 11 sectors, I should say, are higher. So we'll revisit the market in just a moment. That run to 9,000 though is hot, and we've got high energy as well coming through. We've got reporting season coming as well with these mid-season metrics, most of which are full year results. We had a chat with the CEO of Cochlear, Dig Howitt, earlier on. He's been so generous with his time to AusBiz over the years. We had a chat about the new product that's just about to be launched in the United States, tariffs, and why that services sales side of the business did way. So you can check that out online, ausbiz.com.au. We've got a special reporting season. Well, they call it a rail on a website. I never know if that's an inside term or not, but we've got a special section on the website where you can catch up with all of our reporting season coverage from throughout the week. We've got great CEO interviews there, plenty of analysis, importantly, as well. And of course, all of us here at AusBiz will be good people, and we'll be getting our sleep through this weekend because next week is an absolute, cracker when it comes to reporting season. So taking a deep breath, it's just, muscle memory when it comes to this results scenario. Okay, let's get to it. Let's look at these sectors today. Ampol is responsible for some of the lift here. You can see Woodside, no help at all, but Ampol, in the wake of that deal done with EG, it's doing really well, up by 7%. So Ampol up by 2.4%, $28.15 by Macquarie, its price target. Macquarie saying that the deal looks sensible. We've got, commentary that Jefferies is saying that the deal has parallels with the past. And so, it's all looking like systems go for Ampol. Beach Energy, in the wake of a disappointing update in terms of production, doing well today, up by 1.4%. We did see oil prices overnight up by about 2%. Here is where the real rubber hits the road. We've had an update coming from ANZ, market rewarding the company. Second day of rewarding Westpac for its quarterly update, which was published yesterday, uplift in profits. And it's Commonwealth Bank. We've got an interview with Matt Common on that reporting season section on the website if you'd like to have a look. Check out the miners. They're helping the overall scenario as well with BHP, Rio, Fortescue, South 32 and MinRes up. I should also mention that Lynas is one of the best performers in percentage terms, as well as Sandfire Resources up by close to 5%. Many of the conversations that I've had includes Jumei Liu from TenCap at the beginning of the week, who was saying, look, it's the resources names, the cyclical names that you really want to keep an eye on through this reporting season. I mentioned Cochlear's Dig Howitt joined us earlier. Full year sales increased to 4%, by 4%, I should say, to $2.35 billion. Strong growth in cochlear and acoustic implants offset by a decline in services revenue. Amcor getting smashed, reporting net sales of around $5 billion US for the fourth quarter. Mirvac returning to profit in the past financial year with a stat profit of $68 million, even as full year revenue fell 10% to $2.74 billion. Baby Bunting, I'll give it away. It was the stock of the day. We'll bring you the analysis later, but up by, get this, 43% to $2.56 on that future store program that it continues to roll out. And Healthco REIT coming under pressure. It delivered FFO of $36.5 million, saying that it does remain convinced that the private hospital, strategy is right. It just needs to work through some of these health scope problems. And Westpac, I should say, there's Macquarie lifting its price target. I mentioned Jefferies in relation to Ampol. Also Telstra, brokerage is pretty upbeat after that buyback launch, with Morningstar upgrading ASX on strong leadership decisions. Looks like it's going opposite to what the market is doing in the wake of its result yesterday. CEO Helen Lofthouse voluntarily foregoing her short-term bonus. Some of the other execs having their bonuses cut as well, but don't stress, they're still getting well paid. All right, let's welcome to the COB, as we do each and every Friday when he's in town, Shane Oliver from AMP. Shane, nice to see you. What's going on this Friday? We started the session a little bit muted because changing expectations apparently around U.S. interest rate cuts in relation to that producer price index that was released overnight. But even the China data that was weak couldn't derail some of the gains here.
Yeah, it's almost like the market's covered in Teflon lately as it keeps going to new highs. I have a feeling there's still a lot of optimism about the prospect of further interest rate cuts. We're seeing more economists talk about the cash rate going down to 2.85%, which incidentally is our own forecast and has been for a while. And on top of that, the Reserve Bank's own assumptions assume that it gets to pretty much around that level anyway. And that's, of course, on the back of the confirmation that we've got that inflation is on track for their 2 to 3% target, the midpoint of the target on their own forecast in that chart there. They simply confirmed that they see it staying around target, which I think is very good news. I'm a little bit surprised you didn't see more of a dip on the back of the Chinese data, which was well and truly on the soft side. I guess the complication with the Chinese data is that it's not so bad to lead to big concerns about commodity prices, but by the same token, it's soft enough to lead to expectations of more policy stimulus. And I think that's probably what helped the market today, despite those soft readings. And of course, globally, the PPI, the producer price index in the US, wasn't as good as could have been hoped for. In fact, it was quite bad, and it leaves open the way for potential bigger impact from tariffs on the US inflation numbers. But by the same token, the market in the US still seems fairly confident that the Fed will start cutting in September. I noticed the market expectation went down from about 105% for September for a 25-point cut down to about 90% when I last looked. So there's still that optimism around that Fed rate cuts are coming. And of course, we know from history that whenever the Fed is cutting, as long as there's no recession, shares tend to go higher.
So what you're saying is it's a bit of MOMO, so it's a bit of momentum, Teflon markets. It's the rate cut expectations in the US pushing US markets, repeatedly to record highs this week. How much did US earnings have to do with that?
Well, it's probably got a lot to do with it, because if you think back to 5 or 6 weeks ago, I get a little confused about the US earnings season now. It seems to go a lot longer than it used to. It used to go for about 4 weeks. Now it stretches all the way out to the NVIDIA result, which I guess is in the next week or so. But you can see from that chart there, if you'll focus on the red dots, that shows the number of companies surprising on the upside. The norm is about 76% upside surprise. We're running about 81%. So that last red dot is on the high side. So that's good news. The other aspect is that the blue bars show the rate of annual growth in profits, obviously the most recent one up to the June quarter, and it shows growth now at 11%. So we're 91% of the way through the reporting season. Profits are up 11%. At the start of reporting season, just 6 weeks ago now, that number was 4.1%. So you've seen a substantial upgrade to US earnings, the level of US earnings. And at the same time, I think you're still seeing upwards revisions to forward-looking earnings expectations. So that's playing a big role here. Obviously, the market was worried about the impact of all the tariff uncertainty and the other noise coming out of the Trump administration. But so far, US companies seem to be handling it reasonably well.
Yeah. It's an interesting one. I mean, I'm not going to take anything away from the enthusiasm in the market, but to my earlier point, I wonder when you look at that activity data out of China, how we square that up with the enthusiasm that we're seeing in equities, particularly where we sit here in Australia. Shane?
Yeah, it's a good question. I mean, it's not going to keep going up like this forever. I would, to be honest with you, I was thinking, good July. July is a good month for markets, and rougher August, September. The Chinese economic data, I mean, you could argue is a bit of a red flag there. It is on the soft side. The chart doesn't. I mean, the chart there has a 3-month moving average through it, so it looks a bit smooth. But we did see downside surprise for retail sales, industrial production, investment in China. And of course, you can see in that chart there that property investment, this is residential property investment, continuing to fall. And the pace of decline in home prices, whether they're new or used, is still well and truly on the downside, despite 6 months ago looking like it was potentially stabilising. So that's certainly a concern. I guess the other concern, in relation to the US, and this is on the tariff front, the producer price inflation number does include some trade services numbers, and it looks like it was a little bit on the upside there, which does raise some risk that US companies, in terms of trade, are seeing upwards pressure, and there is a risk that could flow through to the CPI. And of course, there's a negative impact from the tariffs. They're still running at, if you add the numbers all up, it gets a bit complicated because they keep changing every few days, although the last week's been relatively stable, thankfully. But roughly speaking, you're looking at an average tariff on imports coming to the US of somewhere between 18 and 20%, probably around the 20% level. That is compared to about 2.5% at the start of the year. So that's a massive increase. What's that, 8 times or something, 8-fold increase from the start of the year. And obviously that's going to have some economic impact. It's just that it hasn't shown up yet. So we can still go through a period where you start to see some softer data. Maybe we're seeing that on the jobs numbers. Of course, Trump doesn't like bad news on jobs, and if you report that, then you're prone to get sacked, as the head of the BLS found out, which is probably why no credible economist applied for that job, because they know if they just report the data as it is, if it's on the wrong side, you might lose your job. So anyway, that's the way things are going over there. But if we do get more softer data coming out of the US, and you can look at some of the private surveys, if the question mark starts to loom over the BLS and elsewhere, then that may concern markets a little bit. There's obviously uncertainty about the Ukraine situation. Trump has said if there's no progress towards a peace deal, then he's going to put these secondary tariffs on, which obviously affects oil supplies going to India and China and so on. So there's a risk around that front. There is a serious risk that the US government will have another shutdown at the end of September. So that could well be a factor. And of course, valuations are somewhat stretched here. If you look at PEs in the US, forward PE is around 26 times. The bond earnings yield gap is close to 0, so very low risk premium. PE in Australia is also well above average levels. I think it's about 20 times forward earnings compared to an average around 15 times. So there are those risks out there that you could go through a rougher patch, that it's not just going to keep sailing up like this. And to be honest with you, as someone who's been around investment markets for a long time, I kind of like corrections every so often. I mean, they're not so nice when you're going through them. Yeah. It feels kind of scary, but they sort of reset the market and help set it up for more sustained gains ahead. Whereas if it just keeps going higher and higher, more and more are sort of sucked into it, and then you get to a point of euphoria, and then you end up with a much bigger risk of a slide in the market. So it would be nice to see a correction. There are some potential triggers out there, and the markets are vulnerable. But even if you look beyond that, let's take a 6 to 12 month view. Trump wants his party to do well in the midterms. The Fed, I think, will sooner or later, probably in September, if not a bit later, start cutting interest rates. Other central banks, I think, will continue to cut interest rates. And that, I think, providing we don't have a recession, it's not our base case, should be positive for share markets. It's just that you could still go through a rougher patch, particularly through the remainder of August into September in the interim.
Look, not to get too far off course, but you should check out some of the memes online of this E.J. Antoni, who has been Trump's pick to head the BLS now after he fired that poor person in the wake of that latest jobs read. It's pretty funny. I have something else I want to ask you about, but just quickly, score of 1 to 10 so far, the Aussie reporting season.
Oh, look, got to be careful because it's early days yet.
Yeah.
But so far, I'd say maybe 7 out of 10. But I'm just conscious that we're only 28% of the way through the earnings reporting season, so less than a third. You can see the numbers there do look quite impressive. 80% of companies reporting earnings up on a year ago, and 68% reporting dividends up on a year ago, and we've got more upside surprise than downside surprise. It's just that I kind of remember back to February, it was a bit like this at the start of the December quarter earnings season in February. Good results, particularly from Nick Scali and JB Hi-Fi. Guess what? Same thing again last Friday and this Monday on that front. Banks still doing well, although bank valuations, particularly for CBA, are a lot higher at the moment. But still a good result from CBA and a good result from Westpac. It's just that as the reporting season goes on, it tends to get softer results.
Yeah.
Now, hopefully that's not the case, but you really do need to see stronger earnings in Australia. And I think that's what the market is trying to factor in here. We've had, if this one turns out in line with expectations, that'll be 3 financial years in a row of falling earnings per share in Australia. And the market, I think, is really hanging out for growth returning next year. Hopefully we'll get it, and that's what the market is anticipating. But if the guidance in the company results, particularly next week, which is the big week for reporting season, if it's on the soft side, then it could be a little bit of a concern for our market.
Now, what I wanted to ask you about was, hey, baby, that's show business for you and baby. So Taylor Swift released that playlist. Have you listened to it, Shane?
I haven't yet. Last I heard was that she'd released the tracks but hadn't released the album yet. So
no, yeah, the Showgirl album not out yet, but this one's on Spotify. I just thought, you'll be buying the album though, won't you?
I'll have to check that out. It got me really excited on the RBA day because the countdown was occurring around about the same time as the RBA, and then of course the news broke that album was coming out around about the same time as well. So I got a double whammy of good news. We got that rate cut, and we got dovish guidance, you could say. So the two together, and as a Swiftie, it was really good news. So I'm kind of excited about that. It seems as if since I saw her last year, there's been a bit of a drought in terms of new Taylor music, and maybe I'd sort of gone through a similar phenomenon to what I experienced with ABBA back in the 70s. I'd had so much of Taylor Swift, I feel like I had an ABBA in the 70s, that I was sort of waiting for a break. So I had the break now, so I'm willing to get excited about the new album. And I think the good news is that she's gone back to the producer she used for Reputation 1989, and what was the other one? There was one other along the way. So that's good, because I kind of found the last few albums a bit too tame.
Yeah.
If you like.
Shane.
I want something more upbeat, like Style or something.
Yeah, love your work. Have a great weekend. I'm going to listen to the playlist this weekend myself. Take care.
Check that out. In fact, I'll go and have a look now.
Yeah, please do. We'll chat about it next week. And I've got to say, if anybody is on LinkedIn out there, Stephen Koukoulis, who you might know, we have him on the program sometimes for Market Economics. He posted a newspaper clipping from sometime mid-90s, 1995, and it featured him, and it also featured a picture of Mr. Shane Oliver from AMP, and good-looking rooster. I digress, though. Let's get back to reporting season, shall we? And the stock of the day, baby bunting. Experts Luke Winchester from Merriweather Capital and Richard Hemming from Under the Radar report.
You look at the way they've tiered their guidance. They're expecting 1 to 3% same-store sales growth in the first half. Some of that driven by, stores have to close for 8 to 10 weeks while they refurb. But then second half going to 6 to 8%, and then targeting 15 to 25% on these new stores when they open. So I think there's a little bit of, maybe not blue sky is the right word, but some optimism in that sort of guidance there. So I just, say hold. Let's wait and see how they go. It's a big CapEx program for these guys. But if they make it work, it's early days, but the signs are pretty good for these returns.
The momentum's there. There's a bit of optimism in the share price, but it's come from being overtly pessimistic. And management's got a good sort of strategy of home brand, so that should that should assist margin growth, and margins held their own. So I think it's probably a stock that I would hold.
Well, if this is your shorthand to what happened on the market today, let's take a look at some of the market leaders. Ampol, I already told you why, up by 7.25%. IDP Education. So a bit of news this week that perhaps the incoming intake for foreign students won't be as bad as we had first anticipated. Liontown and Linus on there. Sandfire Resources as well, not on any news, but I think a runner-up should go to Aurora. It's been a bit troubled. But look, we've got a new bull coming through, seeing that Saver Glass, that acquisition turning a corner according to its recent results. So we've got, an endorsement coming through from Jefferies, and that's helped put a bit of a fire under its share price today. Laggards, though, Temple & Webster, so giving up some of the gains. Maybe when people read through the detail of the report, I'm not doubting that it is a quality company selling quality goods, but boy, anybody I speak with about the valuation, look, it lifts some eyebrow. There are obviously plenty of fans, but plenty of eyebrows lifted as well. Amcor, in the wake of its result, really disappointing. Corporate travel down, AGL as well, suffering, and Life 360, both of which reported this week as well. In the smaller end of town, look no further than Baby Bunting's, up by 43% to $2.56. Although, as you heard, my guests wouldn't be buying it right now. They wouldn't be chasing it. Really difficult after a share price lift like this. And of course, if you listen to the extended version of that analysis, Richard Hemming from Under the Radar Report points to the longer 5-year chart. In the laggards, so those that didn't perform very well in the small cap space, Gold Hydrogen, GBM Resources, and Sinlay Milk. Tonight, we get U.S. retail sales, we get the U.S. Empire State Manufacturing Index, import and export data, and the University of Michigan Consumer Confidence Index. Next week, we get the Consumer Confidence, the monthly from Westpac, housing data, FOMC meeting minutes, the S&P Global PMIs, and that's not even scratching the surface when it comes to the results that are due. So BHP, Woodside, Telix, and Zip. Okay, here we go. Taking a look at this local market. What a session. The S&P ASX 200 finishing at 8,938. That's up by 0.75%. When I look at the sectors that helped bring us along, look no further than the financials. That was the best performing sector, but the miners came to the party. We saw the insurers after what's been a bit of a troubled week as well, rebounding. IAG up by 3, close to 4%. Consumer discretionary, as a general rule, was higher, and even some in the energy space, including Ampol, helping to drive this market to, what has to be a record close. It is a record close. Wow. There you go. It's a Friday. We hope you have a happy and healthy weekend. And we look forward to seeing you on Monday. If there's anything you've missed, you can find it online throughout ausbiz.com.au. Stay with us.
The COB is brought to you by Montgomery Investment Management. The world is volatile. Your financial future doesn't have to be. Find out more at montinvest.com.